If I give you some money, I lend it to you, what am I going to get back? Am I going to get back what I lend to you plus a bit more, right?
Oh, I don't know. I guess it depends on how much I have at that
Well, it
time.
also depends on what the central bank has said the interest rates should be.
The central bank. Yes.
Have you been following this?
I've been trying to ignore it because it's rather really kind of confusing, the messages that I've been getting from them.
4 years ago, I read something about the negative interest rates. Interest rates are negative.
I haven't seen that on my bank account. I mean, money keeps disappearing. Yes. So.
Yes, that's not negative interest rates.
That's not it?
That's you
Ah,
spending it.
I thought
that's
I could
disappearing
just-
into your stomach, down your throat, onto that nice clothing that you wear.
I thought
Those
I could
orange
just.
trousers you had on the other day.
I thought I was gonna just be able to blame Draghi for all of this.
You can do that anyway. We'll get onto him another time. 4 years since they started negative interest rates. I think it's actually about time we knew what's going on before they stop doing it, and then we'll really never get to understand.
All right.
So do you think we should get someone on to talk about negative interest rates?
Let's do it.
That's very positive.
It is very positive.
But before we do, talking about positive, people should subscribe. That would be the most positive thing they could do right now, and it will make them feel good because being positive makes you feel good. I wonder if negative interest rates makes people not feel good. We'll have to get to that. Subscribe to A Dictionary of Finance on iTunes, on Spotify, on Stitcher. You can also listen to it now on YouTube because that's where the kids are at. So we're going after them, you see, apparently.
Wow.
Mm-hmm.
Wow.
So subscribe, and in the meantime, rate it as well. So negative interest rates. We've got someone who's very positive here to talk about negative interest rates. It's Marcello Grazioso. I hope I'm saying that exactly right. I really want to get that word right. Some names I don't really care about, and it's easy to say, like Allar Tankler. Actually, how should I say that?
That's as close as anyone really gets.
Well, let's have the real thing.
Allar Tankler.
It sounds much better like that. And if I was actually Marcello Grazioso, I would say my name like this.
Marcello Grazioso.
Oh, come on.
Better. That's better.
I'm just going to edit that in so that every time I say Marcello's name during the course of this podcast,
it's
it'll actually be him
him
saying it.
That's good.
And people will think, wow, that guy's got great Italian. So Marcello is liquidity portfolio manager in the Treasury Department at the European Investment Bank and has seen financial crisis from many different angles. We're going to be talking about economics and finance and how banks work monetary policy to handle the things that they're up against, central banks, that is. But Marcello, you've seen, how many financial crises have you actually been through?
Well, I've been through 3 right now. So because I started working when the bubble burst, the internet bubble burst. That was back in 2000. And then I got to see the 2007 crisis, of course, because I was still working at Goldman in the trading desk. So you could actually see the news flow every day that was affecting the daily activity and the sentiment on the trading floor. In fact, I remember still as it was yesterday, the day that Lehman went down, there was a lot of chaos, email, phone calls, people being called back at the trading desk immediately. There was like 10 p.m. In the evening on a Sunday, so you can imagine you could see the trading desk still like if it was daylight, so almost full.
That was the American investment bank, Lehman Brothers, which some of our listeners, I don't want to make any of us feel old, but some of our listeners might not really know about that. But it was an investment bank that went bust in 2008.
Yes, and then basically when I joined the European Investment Bank in 2010, there was the sovereign crisis that kicked in. So I could actually also look at that from a different perspective, which was the mostly a political let's say, view, of course, with the financial and economic implications, because even a political crisis becomes a financial and an economic crisis eventually. So it was interesting. Good times in bad time, let's say.
Did you come to Luxembourg because you wanted to follow
the
crises, or did you have some other secret reason for it?
No, it was mostly personal reason to reunite with my wife here in Luxembourg. And
just like you, Alain.
Just like me, yes.
Yeah,
it's a
whereas
very romantic story.
Yeah.
And you?
No, I dragged my family here. They loved it. My wife is American, so she looked at all the pictures of Luxembourg and said, "It's so cute," and she wanted to come here right away. So let's get on to negative interest rates. We all know what an interest rate is, particularly if we've listened to the third podcast we did. If you haven't listened to it, go back and listen to that, because it'll explain everything you need to know about interest rates. But I think the main thing that we were getting at there is that someone gives you something and you give it back to them plus a little bit more. That's the interest. It keeps you interested, right? Well, how can that be negative? Why would I give you something if I'm going to get back even less? Is that how it works?
Well, exactly. So let's start, I think, first by saying that the nominal interest rates that we are talking about right now, being negative, been kind of a new news for everybody. It's kind of an uncharted territory which we started walking along together in the financial industry. I mean, everybody together with the decisions made by the banks, by the central banks. While in reality, in life, real interest rates have been negative. But it's not that common to look at the real interest rate when you make a financial assessment or assumptions, or also look at the financial decisions.
Real interest rates, meaning nominal interest rates minus inflation.
Correct.
Right? Okay.
Correct. So basically, the interest rates, nominal and real, are attached to inflation and depend on inflation. So it depends on the targets of the central banks at the point where they see the economy going. Whether there is too much inflation or too low inflation. In Europe, for example, there was the case of fear of deflation with prices going down. That's what moved most of the central banks to start basically going into negative territory in terms of nominal interest rates.
And so can you explain how that works in practical terms? So a central bank declares the interest rate to be negative something. Let's say it's minus 0.5. How does that affect the end user on the street?
So first of all, let's say from central bank setting the nominal interest rates negative to, like, let's say in the Europe, minus 40 basis points, which is minus 0.4%. That means that if a bank has in the market, a commercial bank, a wholesale bank has excess cash that needs to place outside, then it can go to the central bank, place the cash, and get minus 0.4% in return, which basically means getting less at the end of the tenor. This is for the overnight deposit facility, of course. So basically, by doing that, the central bank was kind of discouraging the wholesale banks or commercial banks to place cash at the central bank and make use of those cash via investing in different assets, providing more loans to the outside world, and everything else. In reality, then, when we see the full transmission mechanism, let's say, the negative interest rates charged by the central bank to the commercial banks didn't actually touch so direct the common, like me or you, the common person on the street. Because the commercial banks and retail banks, in this case, they didn't set the interest paid on our deposit to negative territory. They kept it to zero. So fine, which is good. We don't get paid, but actually we don't pay more.
But why didn't they do that? Was it because some of the contracts that we signed with those banks when we opened the accounts didn't allow them to?
No, they had the flexibility, of course, to change the contract, let's say, and the conditions. Like you see that reflected mainly in the fees that you're paying. So
they do tend to go up every now and then.
Correct.
Yes.
So they basically made up for the loss of income on the net interest margin, let's say, via increasing the commission, the fees income.
So that sounds like it didn't really work then. If the central bank is trying to get the money out there, but all that's actually happening is that the commercial banks are saying to you and me and Allah, you have to pay higher fees, that doesn't actually encourage me to say, it's time to go out and spend.
Well, let's say again, they couldn't set the interest rates to negative because otherwise there would be there would be fear of bank run. So imagine all the account holders going to the bank and took the money out and just in order not to lose.
They would go to the bank and say it's going to be less, so I have to take it out, a run on the bank. Like the one in Mary Poppins, which we've referred to before on this podcast. It's becoming the Mary Poppins podcast. Is there somewhere in this chain that it actually has worked?
Investments honestly have gone up, and we see now in terms of picking up of the economy. Of course, as I said before, this was an uncharted territory for everybody. So models, economic models, macroeconomic models of rates cut or rates increase have been always there and with different names attached of major economies in the world. But nobody had ever seen things going negative. So the zero, let's say, was also seen as a kind of behavioral floor. Let's say, you cannot go to below zero. Come on, that was the idea, let's say. But when so the central bank had to start moving along the way with us. So there were no empirical data showing that if the rates were going to be negative, this would happen. So everything is new for them as well. So they basically, the central bankers and all the economists looking at the data, they see the different changes in data from time to time. But of course, it took a long time. I mean, we are talking about 2014 when the first cut into negative territory was made by the central bank. And we are now in 2018 and we are seeing a bit of economic growth kicking up. So there are no more fear of deflation. So I can say, personally, that it has worked. Maybe they could have gone, the central bankers could have gone more, let's say, more direct and with more power, let's say, instead of touching just a bit, maybe just going, let's go to minus 1% all of a sudden. But of course, they didn't do it. As I said, uncharted territory, they had to move with caution and by looking at how the data would react.
This was the European Central Bank in Frankfurt. Is that the only central bank?
No, there are a number of central banks. So I think the Denmark, Sweden, Switzerland, of course, they all cut rates in around the summer of 2014. They started doing that. And of course, the difference is also country related, The ultimate effect would be a devaluation of the currency, because if you bring down the rates, your currency got devalued, which is what they obtained partially in the euro. Of course, there were contrasting forces that didn't devalue the euro much. But for example, in Switzerland was the opposite. The Swiss franc was extremely overvalued. Then it got stronger, so they had to intervene, fixing the exchange rate with the euro. So
can we just walk through why the interest rate? Why bringing down the interest rate would devalue the currency? Yeah,
because basically it makes your currency less attractable. So you would have it's a supply and demand effect basically. So if your currency is not earning that much, then people would not want to hold the currency. So would sell the currency, the currency gets devalued, but on the other side, that's good for exports, for example. So it increases your exports, your trade balance goes up, and your output eventually goes up. So that was the link that the central bank was trying to make, because economic growth non-existent in Europe, in the Eurozone, they try to push the output and being fears of deflation. If you push the output, then your supply again a demand effect. You have more request, more demand for your goods. The prices of your good go up.
So it is always very complicated, actually, isn't it? As dedicated listeners of this podcast will know. So when you think, we'll do the interest rates and the inflation, but then suddenly you got to think about the currency and what happens there. So everything is always connected, which leads me to ask, was this thing with the interest rates making them negative the only thing the central banks were doing? They thought that would solve everything?
No, exactly. You are right. I mean, this is one of the tools that they used, and of course, then in the case of the European Central Bank, for example, we can talk about that. They started the quantitative easing like the Fed did, so they increased the size of the balance sheet, and we've seen for the first time a European Central Bank going active in the market and buying government bonds, sovereigns, and other assets. Then they extended their asset purchase program to other assets, and so they start buying ABS, so asset-backed security, covered bonds, and so in a way of like, let's say, providing still more liquidity to the market. And on the contrary, I mean, the side effect was that there were less assets to buy for the, let's say, for the investors out there, for pension funds, insurance companies, or the trading desk of corporate banks, wholesale banks. There were out of the blue, the supply has diminished in the market. So there are not many assets that where the institutional investors can diversify their portfolio.
So in that sense, it seems like the two measures work against each other. With the interest rates, they're trying to tell you that, you know, don't keep your money in the bank, go and invest. At the same time, with the quantitative easing, they're buying up the assets to invest in. So what do I do with my money?
In a way, yes, correct. That's why we've seen a lot of institutional investors sitting on a huge amount of cash in this past months and years, basically. And if you go from here, I mean, of course, some of them have increased some banks have seen also since the rates went down, they've seen also their refixing of the loans that they made as assets basically going down. So they started on the other side to increase their loan activity, which was good to sustain the economy in a way. So we've seen a lot of let's say side effects that as I said, in hindsight, with the benefit of hindsight, we can see they're working. So
but essentially what they were trying to do is to say, okay, you're a bank, you've got some money, normally you would give it to me, but I'm going to give you a negative interest rate, so you won't. And then also I'm going to go out and buy all the safe investments that you would have put your money into. Yeah. So now you have to put your money into riskier stuff, correct. which is where the central bank wants you to put it.
And this improved the credit quality out there, actually. So that was a good sign, because diversifying the asset into riskier investment, then they makes credit quality overall better, because it lowers basically the risk premium of the assets along the curve. And it's again supply and demand. So risk premium go down, basically flat along the curve, and it's working. I mean, as I said, I was very skeptical, personally speaking. This is my opinion again. So when I saw rates going negative back in 2014, I was very skeptical, but if you could look at that, back in time in 2014 with the data that we now have, It's actually worked, so it's working. So Eurozone, we've seen a pickup in the economic activity, and
But it's still negative interest rates.
still negative interest rates, and still will be at least until September this year. So talks are about the ECB, the European Central Bank, starting to taper what we call in financial terms, let's say. So basically reducing the asset purchase that they make and bringing back the rates to positive level, first to zero, then to positive.
You mentioned a term a little earlier, which I want to ask you about, liquidity.
Yeah.
What's liquidity, and where does that really come into this whole thing?
Well, liquidity comes in the fact that comes into play because, as I said, the European Central Bank cutting rates provides liquidity to the market already. That's the monetary tool that they use. And the central bank assessing a certain type of market, which was the investment grade bonds that they started buying, left, as I said, the institutional investor with more liquidity out there to buy more assets, and eventually we've seen a large, as I said, large pile of cash held at the banks everywhere in Europe in the past years.
So then they need liquidity managers.
They need liquidity managers.
How does this affect the Treasury Directorate where you are at the European Investment Bank? You've got all this money. You can't just hold on to it. So what do you do with it? And you can hold on to it, but it'll become less than it is now. So what do you do with it?
No, of course we have our investment guidelines, and we need to use the cash and go out there in the market, and of course wherever possible we buy all the assets that are eligible for our investments, and of course we've seen a hit because I think in the past 4 years, 3 years and a half, I mean, there's not a single asset with positive interest rate that we bought. We are very conservative institution, and we have strict guidelines, of course, and but in terms of our liquidity, we manage it up to 1 year maximum in terms of investment maturity. And I wouldn't go in much detail about our guidelines, which are more restrictive because it's the weighted average life of our portfolio is even smaller than 1 year. So, but we've seen a hit in terms of our investment. We bought all assets at negative rates. And but in general, has to be said that the treasury in any bank is a cost center. So because cash is expensive to hold. So so managing cash is expensive. So it, of course, we have our internal measures where we make our calculations on the, let's say, the economic contribution and financial contribution that we made, and being the benchmark rates also negative, we can demonstrate that we managed to invest our cash in an effective way, in a productive way anyway. So, although at negative levels.
It will be very interesting to see what happens after September, and maybe your job will become easier managing that cash with slightly more positive interest rates afterwards.
Well, it depends, of course. It's always a matter of supply and demand, as I said. So, of course, the ECB going out of the picture, hopefully, then that means that they brought the world, the economic world, to a new starting point where people will have to adapt to new size and new investment profile and investment activity. So the activity is going to be there. As I said, I was scared about that in 2014, but actually the market kept working. So, of course, we've seen the yield curve going down massively and flat, at least in the short end. Up to 2 years, it was basically flat, but things have worked. So
We're going to bring this to a close in a moment, as soon as you've told us what the yield curve is.
okay, the yield curve is basically if you put the return interest rate on one axis, let's say maturity on the other one, it basically shows where at different point in time what's your let's say expected interest rate.
So between like a bond of a note of 1 year and a bond of 30 years, all the way out like that.
Yeah, and usually it's upward sloping in a normal environment with positive interest rates and positive risk premia and positive term premium. In our case, right now, we've seen the rates going negative, curve flattening across all maturities because of the basically the term premia was brought down to zero, and the risk premia, as I said, was basically also brought down to zero because the let's say the objective of the central bank was to push for the other banks for riskier profile, riskier assets, so that again supply and demand, that more supply for riskier assets brings down the risk premium, and so it worked.
It worked. Okay. Well, that's the takeaway. It worked. Okay, good. It is complicated stuff. I thought our Bitcoin episode last week was complicated, or even the one before on Bitcoin Part 1. But, you can listen to them and compare to see whether Bitcoin is more complicated than quantitative easing and negative interest rates. I feel positive about this particular podcast. I think it went very well. Don't forget to subscribe. A Dictionary of Finance from the European Investment Bank.